Change is in the air, and it's igniting debate. President Donald Trump has recently thrown his support behind a striking proposal, putting an end to the long-standing tradition of public companies reporting their financial results every quarter. If enacted, this shift could send shockwaves through Wall Street and boardrooms alike, transforming how businesses operate and how investors access vital information. But here's where it gets controversial. Would this change liberate American companies or leave investors and analysts in the dark? Posting on Truth Social this morning, Trump argued that companies shouldn't be forced to file reports 4 times a year. Instead, he advocated for semi-annual reporting, meaning financial disclosures would occur just twice each year. According to Trump, this break from the norm could save companies money and let executives concentrate on what really matters, running their businesses effectively for the long haul. He didn't stop there. Trump drew a sharp contrast between U.S. corporations, which he claims are obsessed with short-term results, and countries like China, known for their decade-spanning business strategies. Did you ever hear the statement that China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis? Not good, he exclaimed. It's a punchy critique that echoes concerns already raised by business leaders like J.P. Morgan Chase CEO Jamie Dimon and investing legend Warren Buffett, both of whom have openly worried about the dangers of so-called short-termism, the tendency to chase quick gains at the expense of bigger future opportunities. And this is the part most people miss. The frustration with quarterly reporting isn't just a Trump thing. In the 2016 presidential election, Hillary Clinton also lamented what she called quarterly capitalism, saying the pressure to please shareholders every few months distracts companies from tackling long-term challenges and innovation. Critics of the quarterly model argue that these frequent reports force executives to focus on meeting immediate targets, leaving little room for investments or decisions that pay off years down the road. Some market watchers even believe the compliance burden has helped shrink the number of public companies in the U.S. as businesses shy away from the regulatory headaches. Still, this dramatic overhaul wouldn't happen overnight. Trump acknowledged the move would rest in the hands of the Securities and Exchange Commission, SEC, the federal regulator that oversees public markets. The SEC's approval would be required before any change took effect. But with momentum brewing, there could be a real opportunity for reform soon. Consider this. The long-term stock exchange, backed by high-profile investors like Andreessen Horowitz and Founders Fund, is preparing to formally petition the SEC to ditch the quarterly reporting requirement in favor of less frequent updates. Bill Hartz, CEO of the exchange, summed up the movement telling the Wall Street Journal, "This is an idea whose time has come. It's not the first time Trump has flirted with this policy. Back in 2018, he publicly urged the SEC to explore a 6-month reporting system, touting the potential for greater flexibility and cost savings. Analysts like Jarrett Seiberg of TD Cowen Washington Research Group say the tide may finally be turning. We believe the switch to semi-annual from quarterly reporting has moved from improbable to probable, though not guaranteed," Seiberg stated in a recent client note. He pointed out there's a growing push within the industry to scrap quarterly filings, and the current SEC chair, Paul Atkins, a Trump nominee, has a reputation for wanting to cut through bureaucratic red tape. This could be, Seiberg noted, an easier win for the SEC to hand to President Trump. Even so, such a change wouldn't be implemented right away. According to Seiberg, SEC officials would require at least 6 months just to draft and justify a new rule. Gathering supporting data and feedback. But let's not overlook what's at stake. Investors, regulators, economists, and policymakers have come to rely on the timely, detailed insights that quarterly reports provide. For instance, earnings updates from airlines can signal shifts in travel demand. quarterly results from big banks shed light on the health of lending activity. And tech giant disclosures reveal the latest developments in fast-evolving sectors like artificial intelligence. Moving to a 6-month cycle could delay access to these critical signals and might even amplify wild swings in stock prices as surprises build up between reporting periods. This issue has the potential to reshape the entire landscape of American finance. Is less frequent reporting a long overdue solution to short-term thinking, or a risky gambit that would leave investors less informed and markets more volatile? And here's a question for you. Would you rather see the U.S. adopt a longer-term view, or do you think quarterly updates are too valuable to give up? Cast your vote in the comments below. Let's hear your take on this hot-button topic.